So welcome all, and I hope you're going to find this interesting. As Pam said, the interesting thing about REMMP when we started is that the experience to date with microfinance in particular had not been strong. And so we really wanted to test to see whether these business models would work. The goals of REMMP were really to increase access of underserved populations to clean energy products, to improve livelihoods and quality of life among the target recipients, and to reduce and minimize the effects of climate-damaging emissions. So that was kind of our overarching goal. And what we wanted to do with this program is to really come up with, as Pam said, commercially viable business models. We wanted to facilitate investment. We wanted to improve the capacity of the private sector to become involved, hence our focus on microfinance organizations and other financial organizations. And we also wanted to document the knowledge that we had gained through this process in a range of different kinds of publications. So, you know, the premise of REMMP at the beginning, because the story had not been such a strong story up until that point, was we really wanted to be able to find organizations that would help us understand this interrelationship between finance, distribution, and technology. Our view was you need three things to be able to get clean energy products into the hands of poor people. You need to have the right kind of technology that works for them. You need to be able to get that technology into the areas where they live and work, and it needs to be financed in a way which makes it affordable. So we had to come up with business models that would give us that kind of triad of sort of end results. And we thought that microfinance and some of the other models that you will hear about in a little while would be the best ways to do it. We also felt that because, again, of some of the lack of success in the early stages, we really needed to have a tailored response. We needed to look at what was going to work in each of those markets. Something that might work in India might not be applicable to Kenya or might not be applicable to Haiti. And, you know, there are different kinds of conditions, there are different kinds of constraints, there are different kinds of external factors that make things work or not work in different contexts. So because it was a kind of an experimental business model oriented approach, we wanted to really tailor things. And we also wanted to get at this notion of scale. People had been talking about scale for some time, but they were coming up with numbers which we from the microfinance sector didn't think sounded like scale-oriented numbers. So what we thought would make sense was to work with organizations that were already achieving scale in other ways, like microfinance organizations that were reaching hundreds of thousands or even millions of people, and see whether we could persuade them, we could talk them into being our partners in testing this new business model, and see whether, you know, taking on that business model, they would then be able to replicate and expand with their client base. So that was kind of the idea behind it. The team, and you see many of the team here, provide a range of different kinds of offerings to the partners. So there's a set of TA activities, which in India there's this lovely word that's used, which is hand-holding. And it's really hand-holding the institution through the initial stages of being skeptical about whether it will work at all, through the operational questions related to implementation, all the things you need to think about in a financial organization, the MIS, the training of the staff, etc. All of that. And we also knew that since this was a bit of a long shot for them, and since a lot of them had had bad experiences in the past, we wanted to add a little tiny sweetener, if you like. So we added what we call a catalytic grant component, where we would encourage some of them to use inexpensive money, free money in effect, through a grant. So this happened in a couple of cases, to be partners with us in this experiment. Many of them actually chose to take the TA without the investment, without the grant. So you know, that was quite interesting. The other thing that we ended up doing was helping these partners hook up with investors, because clearly once the model was beginning to work, investment was going to be needed. And in the case of our partner in Uganda, we also helped them access USAID's Development Credit Authority guarantee, which helped them to leverage capital in the local markets, which we think is actually the most effective way to scale because it's the least expensive and least volatile. So those were some of the ideas there. The business models that we ended up looking at under this program were microfinance, which I think many of you know is the notion of providing a loan to, in our case, almost 100% women clients. And other products as well are provided by microfinance organizations, savings products, insurance products, but our focus was really on loan products. We also looked at a model which was a remittance model, so remittances where people send money from the diaspora back home, and to think about how we could leverage that transaction and those relationships to see if we could help people on the receiving side use some of that money toward clean energy products. And the third model that we ended up looking at was a micro leasing or asset finance model where an energy company, typically in our case solar companies, try and develop their own financing capacity within the institution itself. So for whatever reason, they choose not to partner with a financial institution, either because the relationships were not conducive, the financial institutions were too conservative, or because they thought it would be more profitable for them, or they wanted to control all aspects of the value chain by having it embedded in their institution. So we looked at all three of those models. Before we go into some of the details, I want to just highlight some of the impact that we achieved through the program. So over 343,000 loans were made through this program, which meant that if you multiply that by 5, making the assumption that there are about 5 people per household, that's about 1.7 million people ended up being benefited through that. There were 15 partner organizations: Haiti, Kenya, Uganda, India, and Nepal. Nepal was a kind of a replication of the India program that started a little bit later, and different models happening in each of those countries. The other thing that we're quite proud of is that 72% of all of the customers were women. So in Haiti, the model we used was a model that focused on a remittance company where their clients are actually slightly more male than female, and also the 2 asset finance companies had much, much higher percentages of men. They were up there near 70-80% of their client base were men. So it was really the microfinance organizations that built this number up to 72% women. And 79% of all of the financing ended up going to women. So the story that tells us is that the financing is really important, particularly if you want to reach women. The other thing that was very important to us is that the portfolio at risk, the PAR, was incredibly low. So we talked about this a little bit yesterday at the Winrock event, but in the world of microfinance, under 5% PAR is considered good. Between 5 and 10% PAR is okay, but maybe a bit of an issue to think about, and then above 10% is considered quite worrying. So with the microfinance organizations, the PAR, weighted PAR, was 0.18%, which is very, very low and very strong. So what that tells us is that the portfolios were strong. The energy portfolio was as good as, if not better, than the microfinance portfolio in terms of health. And there was intentionality in the very beginning of REMMP in separating the energy portfolio from the microfinance portfolio. We wanted to be very sure. We didn't know if this experiment would work. We wanted to be very sure that if it didn't work, that we could cut it off quickly, that we would know, we would be able to tell, we would have the data to be able to see it wasn't working, we could cut it off. And if it did work, we wanted to be able to say, hey, it worked because of this input that we provided. So it was really important for us to be able to separate that. There was a 2,300% portfolio growth, which perhaps isn't surprising given that they started from 0. So, that number I think is, I think it's more interesting to see, the percentage growth where the program was extended after 4 years. And so for the next 2 years, there was a 20 to 30% percentage growth. So that's actually a really interesting and sort of strong figure there. And the other part of REMMP, which was quite interesting for us, was that at the very beginning, we didn't really, unlike Pam, we actually weren't focusing on the enterprise side. We were focusing on the microfinance side. And, but microenterprise is there in the title of REMMP. And what we ended up finding, and we'll talk about this later in the day, is that energy businesses ended up being created, partly because it was profitable, and you'll hear a little bit more about that in later sessions. But we had almost 2,000 unintentional energy entrepreneurs created out of the program, which was rather nice. We also leveraged a lot in the way of investment. So two metrics that we were looking at. One was the amount of money dispersed. So $24 million was dispersed by microfinance organizations to their clients. And then separately from that, through all of the partners together, so that 24 million also includes the asset finance companies, and 42 million was brought in investments. The majority of that 42 million actually went to the asset finance companies, but a lot of money came in during the course of REMMP that related to providing financing to the client base. We're also quite proud of our environmental impact because we didn't expect to get this either. Particularly given that most of the focus was on solar, we had a slightly higher projection when we first started, and we weren't getting the CO2 results that we thought, because we had expected that there would be more cook stoves in our mix. But people tell me that a 4.5 megawatt equivalent is like a small solar field. So we're kind of, we think it's quite amazing that out of all of these tiny devices, we were actually able to get that kind of equivalent of capacity installed. And over the lifetime of the product's lifetime, there will be about 340,000 tons of CO2 displaced. So that's a kind of a happy story from an environmental point of view. So I'm going to move to insights that came up under the program. Some of these won't seem so surprising to you, but they were things that were quite interesting for us to see and have moved us from what we consider to be energy lending 101 to now where we are, which is energy lending 201. And they relate to some of the successes and also some of the challenges that we saw along the way. So, and we've divided this into two ways of thinking about it. One is from the perspective of the end users or clients, and the other is from the perspective of the financial institutions. So one of the things that we didn't expect when we started REMMP was that there was going to be quite a large demand among rural and peri-urban clients. We expected that the demand was going to be in the darkest places. When you see that map of the world, and there are all those places which are sort of dark at night, the map of the world at night, we expected we would be looking only in those places. It turned out that that one of the things, and I think many of you know this, once people get a taste of light and clean energy, they want it to be there all the time. They want reliability. And so we ended up finding that markets that were semi-electrified, partially electrified, actually were quite interesting markets for the work that we were doing. So that, to find demand there, and not just in the most difficult places, was something that was not so expected. The other thing that has happened over the course of REMMP is that our client base has become much more aware and much more sophisticated about clean energy. So in the very beginning of REMMP, clients didn't really know what it was. In Haiti, people hadn't really heard about solar, or they thought it was something that wouldn't work, that would break quickly or was too delicate for where they were. There were all of these kind of misconceptions. And the other thing in that time period is there was less availability in terms of variety of products. In the very beginning of REMMP, there were just maybe 2 or 3 companies that were selling the kinds of products that are appropriate for this client base. By the end of REMMP now, there's a proliferation of companies, including in some quite challenging markets like Haiti, and they've become much more sophisticated. The companies, the energy companies have become more sophisticated in what they're offering, and the clients have become much more demanding. So they won't accept a product that's going to fall apart after 6 months. They expect after-sales service. They know what a warranty means. That's also something that was quite interesting. At the beginning of Haiti, no one understood what a warranty was. No one had ever offered them a warranty before for any other product that they had bought. It was one of those situations where you say the word and you're nodding, but you realize after a little while they actually have no idea what you're talking about. So it took a while to even explain the notion of a warranty and that you would be able to have that product serviced if something went wrong within the warranty period. That was a whole education process that we hadn't realized in the very beginning that we were going to deal with. And the other thing that happened, which we found really interesting, was that when we talked to clients in the very beginning of REMMP about the value of the product, in the very beginning it was all about access. They just wanted a light. They wanted a light to switch on, or they wanted to charge their phone. It was kind of very much in the access space. When we did our market research, a few years later, it had moved to reliability. They'd had the light, and maybe grid access was coming in, but now it was about having light all of the time. They wanted reliability. Now, just recently, in our most recent market research, now they're talking about cost savings. The grid has come in, but it's too expensive. And so this evolution we thought was really interesting to see that the sophistication was happening, not just vis-a-vis the type of product, not just vis-a-vis after-sale service, but also in terms of what clients are valuing in the product. So for financial institutions, we have found that from the initial stages where we thought there was kind of one approach, we're actually seeing a proliferation of approaches. So there's a kind of a range of business models. The financial institutions are innovating in response to client need, in response to their demands and aspirations, but also in response to the fact that things are profitable, and they're realizing that this opportunity that they hadn't tapped for all these years can be tapped in multiple ways they haven't thought about. So this kind of proliferation of business models was something we didn't anticipate in the beginning. The other thing that has shifted is perceptions of risk. So in the very beginning, the team found that there was a lot of resistance among top management, particularly the chief risk officer of the microfinance organizations, about whether this would work. Often the story would come up of how they had tried it in the past and it had failed and they had lost money, et cetera, et cetera. Now, because of the success of the program, which has been typically measured in sales volumes, profit to the institution, low portfolio at risk numbers, these risk perceptions have shifted. And the thing that's interesting now is that now our partners are like race horses. So we say this often. In the beginning, it was like climbing up the Himalayas on the back of a donkey, very, very slow process. Now that the successes are there, our partners are like racehorses. They're racing across the steps, but there are new challenges that come with these new business models that now need to be addressed. So it's interesting, at each new stage of development, there are a new set of risks that have to be thought through. The other thing that, again, is not rocket science is that irrespective of how sophisticated an organization is, irrespective of how well it does in its typical microfinance program, as it adapts its program to something like energy lending, you're going to face operational issues. Some of these operational issues are very predictable. You're going to have to look at HR issues. If your energy head leaves, you're going to have to look at training issues, client training issues, product partner issues. All of those kinds of operational issues have come up and need to be addressed. So it's a constant, you never really arrive. You're constantly in a process of having to adapt and adjust and refine the business models. And Pam made this point, I think, 2 years ago when we were in DC, but it's a really important point that gets overlooked. It takes patience, it takes perseverance, and it takes time to get the models right. And so, I think one of the things that ends up happening is you get a taste of good numbers, and then you want more. But, something comes up operationally that sort of hinders things. And that is really important. The other thing that we've noticed in the program is we've sort of aggregated the numbers of all of the partners. But if you look at their individual graphs, they go up, and then there's a plateau. Something's happening here, and then they go up, and then there's a plateau. In the case of India, they went down. We had demonetization. Some of the results went down. So I think, this patience, the sticking with it, working it through really, really makes a difference. So from those learnings, there are a couple of insights that I want you to sort of have in your heads as we think through the rest of this day. That both relate to clients and, again, financial institutions. So one of the things that we at ARC feel really strongly about is having a client-centered approach. So really thinking about clients as at the center of these processes. In terms of clients, again, this is something that I think you all know. Market conditions are changing constantly. It feels as if they changed really a lot in these last 4 years, more than one would expect. And that kind of dynamism has an effect on the client base and requires constant adaptation by financial institutions and by product companies. Our product company partners in India say that 80% of their sales is through microfinance organizations. So one of the interesting things that's happening there is that they are actually going to the microfinance organizations to ask them about adaptations that need to be made to the products. So this dynamism is super exciting. It adds a lot of, I think, energy to the sector, but it also means everyone has to keep up with that process. The other point that we feel very strongly about is the value of market research. And we often get resistance. Oh, that's expensive, or I have to devote too much of my team's time to doing market research. The market research has been essential for us at each point in the process to really understand what's happening from the client's perspective. So, and Guadalupe, who is our lead for market research, will be talking later on. But those insights, I think, were really important in terms of understanding this evolution. The other thing that has happened is that there are really clear client segments for financial institutions. So, a company like Bandhan or a company like Adhika can tell you, or ESAF, can tell you that when it looks at its entire portfolio of clients, it's going to have 60% of its clients in agriculture, 40% of its, I better make the percentages a bit different, 10% of its clients in transportation, 10% in trade, etc. And then when you drill down into those percentages, you start to see that there are kind of categories of businesses that emerge. So when you look into the service sector, you might find that there are a whole bunch of people who are in the hotel business. Now, what we're beginning to see in microfinance, energy lending 201 is that the organizations, from having taken an approach where it was, okay, give me some solar lights and I'll sell them, it's now, okay, my clients are running small hotels, what are their energy needs? Well, they might need lights so that it's on at night, they might need fans, they might need generators, or my clients are in the agricultural sector, what do they need? Well, they may need a pond aeration equipment if they're doing, fish farming, or they may need water pumps, or they may need solar dryers. So that kind of a way of understanding the energy needs of clients' businesses, that is now beginning to emerge. And that's because the clients are presenting themselves and saying, well, this is my business and these are my energy needs. So we're seeing that happen. The other thing that relates to something that I said earlier is that these are end consumers that have relationships of trust. So in the case of microfinance organizations, in the case of companies like money transfer companies, the reason you have an ongoing relationship with your client is because you've been there and you've behaved in a trustworthy way. And so the clients then expect that when it comes to energy products, which means that there's going to be a higher kind of standard that these institutions have to adhere to when it comes to the provision of products. So the after-sales service absolutely has to be there. There has to be quality in terms of the products that are offered. Otherwise, those companies end up having huge reputational risk issues. And the other thing that has kind of emerged for us is this idea, which is quite important in microfinance generally, and we've kind of helped transfer this knowledge to our asset finance partners as well as the money transfer organizations. The idea of end user education so that consumers are making informed choices, which leads to consumer protection. So that if a consumer is being presented with a product that doesn't work for them or that they don't want, that they know to say no, or they know what the value of those products are. They understand the financial element. So this idea of end user education, end user protection is really important. We're trying to help promote responsible sales, not just massive sales volumes. So those were quite interesting in relation to end users. In terms of financial institutions, the thing that became quite interesting was the idea that they can think about their client base as a cross-selling opportunity, that they can really begin to think, okay, so I've got these clients that are in this sector, now I can sell these energy products to them. And I think a lot of microfinance organizations weren't really thinking about the kind of richness of the possibility of cross-selling before this program really became available. We have found with a few of our clients and customers, financial institutions, that they have actually saturated their client base. So we have the first organization to do this was a very small partner in India called DCBS. It had about 15,000 clients. And it literally solarized its entire client base, which we thought was, quite remarkable. And it's happened now to another partner, Sarala, who's here. And this idea that the program has been so successful that they're able to sell solar to all of their clients is quite interesting and not at all what we expected. We have another partner here, Bandhan, that has 10 million clients, and when they've solarized every single one of their clients, I know I can retire at that moment, That will be the sort of ultimate goal. But we've actually been able to do that with a few partners. And so those organizations now are really at the next stage. They're at, even Energy Lending 301. How do we continue this very successful program that is profitable for us when we've saturated our entire client base? And so obviously you can sell new, bigger products, different products, cook stoves, water filters, etc., to that existing client base. You can move into new geographies, and you can start to develop business models like agent models, which we'll talk about later, that help you serve a broader client base and continue that business. The other thing that we're finding at the moment is that the financial institutions, as their programs grow, they're having to kind of adapt and develop new types of financing arrangements that are really tied into client cash flow. And so they're having to reevaluate loan terms. So for example, if they want to offer, which some of them now are doing, they started with tiny solar lanterns. We're now talking about rooftop solar in India. We've got ESAF, which is a small bank that is already talking about rooftop solar. It's an entirely different loan product to offer a loan for a tiny lamp that costs $30 than to offer a loan for solar rooftop. So they're having to really think about these kinds of operational issues. What are the risks associated? What are the terms that make sense? What kind of training? What legal structure even? After-sales service, as they think about expanding their portfolios. And one thing I should mention is that when we first started REMMP, one of the things that would be said to me quite frequently by people on the energy side is, oh, microfinance organizations, maybe they'll sell some lanterns, but they'll never do anything else. They'll never sell anything more than lanterns. And in this 4 or 5 year period, we're at the stage where microfinance organizations are seriously thinking about rooftop solar and much, much bigger products, which, is, we think, part of, that will be a huge achievement of REMMP if we're able to help them move into that space. The other thing that we're finding, and it's just beginning to happen, is that impact investors are really, really interested in this triple bottom line opportunity. And so the financial institutions are finding a big difference from when we started REMMP, which is that now they're able to attract investment on the basis of their energy portfolio. They don't have to hide their energy portfolio and pretend it's not happening. They can actually say, by the way, we have an energy portfolio and that differentiates us. So that kind of earmarking for energy, we think, is really interesting. And all of this comes with challenges. And so, and they're all things that we're going to talk about later. Maybe the margins will diminish. Maybe the business model needs to change. Maybe a different legal structure is necessary. The energy product range might change. Manpower needs might need to be adapted. HR systems may change. Financing will perhaps change. Regulatory and policy issues may come up. All of these kinds of challenges are things that the institutions are now grappling with. So all of that is there for you to sort of have in the back of your head as we go through today, and hopefully we're going to be able to drill down on some of these issues so that you can we can have an exchange on all of them. So for the rest of today, what we're going to do is we're going to go deeper into some of these ideas. We'll talk about what we're going to try and do is describe what's happened in a couple of different institutions and then kind of go deeper into the insights that we've learned with respect to those kinds of models. And we'll also throw in insights that we've picked up through some of the other things that we've done under the umbrella of REMMP. So market research I've talked about, energy diaries research, which Sam and other members of the team led. And we talked about that a little bit last time we were here in DC. We also have customer satisfaction surveys and from the TA. And Chika is the one from the team who's really pulled together these customer satisfaction surveys so that we can sort of see, are our clients really happy with what's going on? Aren't they happy? Are they happier in India than they are in Uganda, than they are in Haiti, etc.? And we've also set the day up in such a way that hopefully we can have some interaction and discussions through the course of the day. So I'm going to stop there. If anyone has any quick questions for me, you're welcome to ask them, but I think you'll probably find that the rest of the day will give you many, many opportunities to ask questions. So I'm happy to take any if you have any quickly now. Yes?
End user education of the solar products, it takes a little bit of time. I compare it to me walking into a computer whilst there is some margin to be made, whilst there is interest income to be earned, the resistance that we are finding in Kenya is people saying, we sell financial products. Now we have to educate our loans officers to educate somebody
Right.
about solar, and it takes time. So I'm just trying to see how the value proposition is framed in terms of the financial.
So I think that later in the day we're gonna have a whole session on what we call energy financial literacy. And we call it energy financial literacy because in the world of microfinance, there's a strong kind of movement toward financial literacy and consumer protection. And so what we've done is we've kind of used the language that microfinance organizations use, and we've kind of tweaked it a bit and said, let's add on this energy component. And so we've developed a curriculum. Saiful from our team is going to illustrate some of that, and we're going to give you a way of seeing a little bit how it works for the women themselves as they go through this process. The institutions have found that financial literacy makes complete sense in terms of their bottom line. More informed consumers are actually more effective consumers. And it's also really been very important as the sector grows to make sure that clients are informed so that the institutions can't be accused of exploiting them. So there's a real interest in those institutions taking this on. So I think we'll come to that point later on, and if we haven't, please push back on us and say, tell me more about this. But we found that the investment is there, and they're really interesting. And actually, Amin from Adhikar is going to talk to you from an MFI perspective about why, hopefully he's going to say this, why he felt like it was a really important investment from their side. And he was able to do the program from the very beginning. Unlike some of our other partners who we started doing work with them and then they did this program later on, he started from the very beginning. So I think you'll hear in his results that it actually paid off, that there's a cost-benefit analysis where you can see that investment in training really makes sense. But that's the case you have to make, basically. Any other questions? Well, before we go on to a very quick tea and zip into the next session. Perfect. Okay, great. So please enjoy, grab a tea, and then we'll set up the next session. Okay?